Loan repayments are one of the most important parts of a home loan, but they're also one of the least understood. Most people focus on the interest rate or the loan size, but what really determines how a loan feels day to day is the repayment structure and how you manage it over time. So let's break down how repayments work, common misunderstandings, and some practical ways to reduce interest and pay your loan off sooner. A standard home loan repayment is made up of two components: principal and interest. The principal is the amount you borrowed, and the interest is what the lender charges you for borrowing that money. In the early years of a home loan, a large portion of each repayment goes toward interest rather than reducing the loan balance. This is normal, but it often catches people off guard. Even though you're making repayments, the loan balance can feel like it's barely moving at first. Loan repayment calculators estimate repayments based on a few inputs: the loan amount, interest rate, loan term, and repayment type. The calculator assumes everything stays the same, which rarely happens in real life. Interest rates move, income change, and people adjust their repayment strategies over time. One common misunderstanding is assuming that a lower interest rate automatically means a better loan. While interest rate matters, the loan term is just as important. A longer loan term reduces repayments but increases the total interest paid. A shorter loan term increases repayments but significantly reduces interest over the life of the loan. One simple strategy to pay your loan off sooner is to keep your loan term longer for flexibility, but voluntarily pay more than the minimum. This gives you breathing room if something changes while still accelerating the loan when cash flow allows. Repayment frequency is another overlooked detail. Switching from monthly to fortnightly or weekly repayments can reduce interest over time because you're making repayments more often. The savings aren't dramatic overnight, but over a 25 or 30-year loan, the difference adds up. Interest-only loans are another area people misunderstand. With interest-only repayments, you're only covering the interest, not reducing the loan balance. This keeps repayments lower in the short term, but when the interest-only period ends, repayments usually increase sharply because the loan now needs to be repaid over a shorter remaining term. Interest-only can be useful in certain situations, but it's important to plan for what happens when that period ends. Offset accounts are one of the most powerful tools for reducing interest. An offset account doesn't change your repayment amount, but it reduces the interest calculated on your loan. This means more of each repayment goes towards the principal, helping you pay the loan off faster without locking money away. Even keeping short-term savings or your salary in an offset can make a meaningful difference over time. Extra repayments are another effective strategy. Even small additional amounts paid consistently can shave years off a loan and save tens of thousands in interest. The key is consistency. One-off lump sums help, but regular extra repayments have a compounding effect. A useful mindset shift is to stop thinking about repayments as a fixed obligation and start thinking about them as a tool. Any dollar that reduces your loan balance early saves interest every year after that. The earlier the extra repayment is made, the more powerful it becomes. Another practical tip is to test your repayments at higher interest rates using a calculator. If your repayments are still comfortable at a higher rate, you're building a buffer into your finances. If they're not, that's a sign to reconsider loan size, structure, or repayment strategy. It's also important to remember that loan repayments are only one part of the cost of owning a home. Insurance, council rates, maintenance, and utilities all sit alongside your mortgage. A repayment that looks affordable on paper needs to work in the context of your full financial picture. Loan repayment calculators are best used as a planning tool. They allow you to test different scenarios, understand trade-offs, and make informed decisions. The mistake is treating the result as a target to stretch towards rather than a guide to work within. The goal isn't just to get approved for a loan. It's to set up repayments that support your lifestyle today and help you become debt-free sooner without unnecessary stress. Understanding how repayments work and using them strategically puts you in control of your loan instead of reacting to it later. And that understanding starts with knowing what the numbers really mean.